Well, the headlines. It's an opportunistic time, a historic time for buyers. For sellers, it's okay depending upon their situation. Now, I'll get into these headlines in a little bit, but first I want to help create some distinctions in the market, give you some perspective to where the housing markets come from, a brief history, and then get into some concepts that I think you'll enjoy having leaving here today. Let's start with the market, the frenzy market, the ultra frenzy market that we had in 2005. It was during the credit bubble. We had lax lending standards. We had so many first-time buyers coming into the market, creating a chain reaction to sales. The market just took off on its own during that time frame. In 2006, the market started to roll over a little bit. The market started outpricing some local buyers in the local community. We still had a very healthy real estate market here in 2006 because of our business community, the job growth that we had. Elsewhere across the nation in 2006, the market had already started to soften because of not the robust job growth that we had here in Seattle. Everything changed on August 3rd, 2007. It was about 10:03 in the morning when I got the notice that the subprime mortgages were going away, that the seller-funded down payment was going away. Sales activity dropped 30% on that day in 2007. So that's when we went from a strong to frenzy market in Seattle to an adjusting market. About a year after that, in I believe it's September 2008, that's when the stock market dropped substantially and also consumer confidence dropped. That's when we entered what we call the 5 months of pain for the residential real estate market. It was over the winter of 2008. At the beginning of 2009, the federal government passed the housing stimulus the stimulus package, which included a home buyer tax credit that started on February 17th of 2009. We just had 18 months of a stable, healthy housing market that was spurred on by that home buyer tax credit, the $8,000 first-time buyer tax credit that then was expanded to a move-up tax credit of $6,500 for those that qualified. That tax credit ended on April 30th of this year, just 5.5 months ago. As we were heading into the last couple months of the tax credit in February, March, and April, we had a surge of sales activity. We brought a lot of buyers who were thinking of buying, brought them forward into the first part of the year, the first 4 months of the year. So we had a surge in sales activity. And after we had our surge, we had an unsurge right after it, which started on May 1st, the day after the tax credit ended. And that's what we've been dealing with right now. So we went through about 2 months of a unsurge, and now we're slowly seeing some additional sales activity, the 3 to 4% sales activity increase from the very low level of the unsurged market that started on May 1st. And the phase we're in right now is to replenish the buyer pool. Because we brought so many buyers forward, we need to replenish the buyer pool. I took a look at some of the stats on the national basis, and right now, for first-time buyers, we're running at a 1.3 million annualized run rate of first-time buyers in the market. A healthy market is approximately 1.7 to 2 million first-time buyers. So you can see we have some ways to go, but that's the phase we're going through right now, is to rebuild the buyer pool. The way the residential market works is it's a sales activity pyramid. The base of the pyramid is first-time buyers. Nationwide, it's 40% of all buyers are first-time buyers. And then you get the chain reaction of sales up the price points. And that's exactly what we saw in the spring. We saw so many first-time buyers coming in, it unleashed the chain, the buyer demand and the seller demand in the marketplace. And we had a strong market in all price ranges in the spring. So we will go through that rebuilding of the buyer pool through the end of the year. I will add hundreds of thousands of additional buyers, first-time buyers into the market here this next year because of replenishing the buyer pool. But we still have a ways to go. to get there. So we're in this phase right now going into next year. So let's get back to the headlines. It's a historic opportunity for buyers. We have a highly favorable affordability index right now for buying a home. It's a historic moment in time. The two key indicators of that index are lower adjusted prices and the historic low interest rates that lead to this very favorable situation for home buyers. The current interest rates on conforming loans, those would be on loans underneath the loan balance of $567,500, are 4% today. For jumbo loans above that loan balance is 4.875. These are historic rates. I remember seeing something that the average rate over the last 30 years was 8%. So you can see how low these rates are. And it's not only a great time for buyers, it's a great time for refinancing in the marketplace. And I've done that personally myself, and I can't wait to do it again. As soon as my lockdown time period ends up here shortly, I'll be refinancing again. And I just want to let you know about refinancing. It's nothing personal. If you've done it once, you can do it again. You look at the math behind it, not the fact that you didn't hit the bottom. If it's right for you to do it mathematically, take a look at doing it on a refinance. For sellers, you really need to have a home financial analysis done. What are you going to do in the future? Are you going to buy another home? Or are you in a distressed situation? Are sellers in a distressed situation? Are they going to sell and rent? What is their objective of what they want to do? But what I mean by home financial analysis is, say you're going to buy another home and move up. There's a benefit to moving up in today's market. Because what's taken place is a compression of the price categories. You have the more affordable price range home. That would be underneath the median and below, the 50 percentile below. You have above the mid and the high end. Well, the high end and the mid are coming down closer on top of the more affordable price range homes. So it creates the situation for price jumping, especially with historic low interest rates. And we have buyers who are price jumping, and they get that benefit. Because the home that they're going to be buying has come down more in aggregate dollars than their current home came down. So you get that one-time benefit of price jumping because of the compression of the price categories in today's market. If you're repositioning your home, say you're buying a home within the same price category, it's okay to do that. It's okay to buy and sell within same market timing, because both homes will go up or go down in the same aspects. It's just today, again, we have those historic low interest rates. If you're moving down, there's a one-time price differential adjustment, because this is on the other side of the issue. The home you're buying has come down less in aggregate dollars than the home you're selling, and there's a one-time differential adjustment to take a look at. Also, in your home financial analysis, you want to take a look at the interest rates. What is the current interest rate of your current home versus the 4 or the 4.875 market rate of today? And there might be a buyer purchase power advantage because it could be a lower interest rate today than you currently have in your current home. And for every tenth of a point, that's 1% in purchase power advantage of lower interest rates. So you can see why that can account into the analysis when you're taking a look at purchasing a home or selling a home. Now, for distressed sellers, we have distressed sellers in the marketplace, unfortunately. And for distressed sellers, recommend that they get a financial and legal review. They need to take a look at what is best for them in today's marketplace. Can they go through the modification? What is their position? Do they have a second or a third on the home? What's the legal ramifications? Because just because you sell in a short sale, it doesn't mean that all the debt goes away of the seconds and the thirds. You release the lien on the property, but the loans could stay there. So that's why you need to get both a financial and a legal review at this time. And we recommend that to all short sales. Because you want to know up front, is there a possibility that the bank is going to accept the short sale or not? Not after you sold the home and spent 6 months going through the process to find out that it is not going to go through.